to Chapter 5 and talking about banking. Those of you who have checking accounts and savings accounts now, this chapter will be a breeze for you, and not necessarily a breeze, it'll be a refresher. A lot of you now, juniors and seniors, you should be looking at getting your first checking and savings account. And I think that's an important step for you to make. Most of you probably have savings accounts from your parents or guardians. You should probably ask them and to see if you have an account in your name. But by the time you become seniors, you should open up your first checking and savings account. And I believe you have to turn 18 to do so. So, Chapter 5 Banking, we're going to cover the services banks offer and its benefits, and also the benefits of a checking and a savings account. So Section 5.1, Financial Services and Institutions, and going right into the financial services that banks provide. Three main categories, we're going to go into detail on each one. Banks provide you the ability to set up a savings account in which you save money. They also give you the ability for payment services in which you can pay from your checking account to another company to buy a product. And banks allow you to borrow, whether you borrow a loan for college, for a house, for a car, etc. Okay? And just know, when we say checking account, if you're unsure what that means, checking account is an account that you have money in that you use almost every day. So think of, instead of carrying cash on you, you put it in a checking account. And you use your checking account every day for your purchases. And with a checking account, you get a debit card. And you use that to swipe. You can use it as debit or credit. You can use it as a credit card, but it's not really a credit card. So just a little background knowledge before we go into more detail, and we'll touch on that as well. So with savings, right, you go to the bank, one of the services they provide is a savings account. It's a safe storage of funds for future needs. You kind of put money in here every time you get paid. Remember, we talked about when you get paid, the first thing you should do is save. Think of it as you're paying yourself again. And even if you start putting just little bit amounts, now that you're 17, 18, it's a skill and a habit that you'll create, so when you're making good money after you graduate college, or if you get your first job right after high school, it's a habit that you'll create and it will be second nature. Savings accounts allow money to grow, because with savings accounts you earn an interest rate, and in this instance, interest rate being good. You put your money in there, and after every year you earn interest and you earn additional income on top of whatever you have in your savings account. So it allows your money to grow. And just another term that we associate with savings is called time deposit. It's money left on the deposit for months or years. Okay? Time, when you hear time, think of savings. You put your money in the savings account and you're not going to touch it for a while. You're just going to let that grow and just keep putting money in there every pay period, every paycheck. And hopefully when you need it for really big purchases, say a house or a car, or for retirement, you have a large amount there for you at that time. Payment services. So this is the second financial service that banks provide. Payment services is transferring money from your personal account to a business or individual. Key phrase here, for payment. So essentially to buy things. An example is when you write a check to buy something, or if you swipe your debit card to buy something, that's payment. That is using payment services of a bank. And a term that associates with payment services, similar to time deposit, this is demand deposit. Think about on demand, you can have your money at any time. On demand, you can spend your money at any time. All right, demand deposit just means money placed in a checking account that you can withdraw at any time. On demand. It's your money on demand whenever you want. Okay, so we have our savings, we have our payment services, that goes along with a checking account, and lastly, borrowing. Okay, when you go to a bank to pay for a house or a car or your student loans, you are borrowing. All right, and that's the last financial service that banks provide. When you borrow money, and that means that you have credit. Whenever you hear the word credit, it means you have borrowed money. Whatever the amount that you need to borrow, that's how much you are borrowing. You have to pay that amount back and interest. Okay, so a quick example, as I believe I sold this example before, Ramapo College was about $20,000 a year. I was there for 4 years. $20,000 times 4 is $80,000. That's how much I had to borrow from the bank. But the cost to borrow that money, banks charge me an interest because banks need to make some money out of this as well. They're just not going to break even. They're not just going to give me $80,000 and then take back $80,000 and not make anything off this. So that's why banks charge interest. So whenever you borrow money, you have to pay that money back and the interest. You can get a short-term credit, short-term loan. For example, if your parents have credit cards, maybe you have a credit card, that is a short-term loan that you have to pay back. And if you don't, you get hit with a high interest rate. We have a chapter on credit cards that we'll go into. And you can get also a long-term credit or borrow for the long term, whether that be mortgage, remember mortgage paying off your house, or auto loan to pay off for your car. So three